Chapter 14 is going to be talking about retirement and estate planning. And I know most of you are sitting here thinking, I have plenty of time. Why do I need to even think about that? But before you know it, it will be time for you to retire. And you can always do estate planning before it's time to retire, because it makes assures that your estate assets go to your heirs and not go to the government. So this is what chapter 14 is going to be about, is basically getting ready for retirement. So one thing you want to do is you want to look at these misconceptions about retirement planning. Right now, you are in your early 20s and you're thinking, oh, I have plenty of time to start saving for retirement. And even if I'm just saving a little bit, it won't help. You spend less money when you retire. I can depend on Social Security or company pension, make that my pension benefits are going to increase with inflation, and that the employer's health insurance and Medicare is going to cover all my expenses retire. Now, the key to these was the word misconception. Um, all of these will not apply when you get ready to start thinking about retirement. So some savings for retirement tips. Start now. I don't care if you're 21 or if you're 31. Time's critical. It creeps up on you. So start now. Start small if you have to. The easiest way is when you get a full-time job, start your deductions from payroll. Save regularly. Be realistic about your returns. If you change job, which you will, surveys show that we usually will change jobs 7 to 10 times. Make sure you keep your old retirement account and roll it over into a new one. And do not touch your savings unless you absolutely have to. This shows the importance of starting to invest early. If you start at 25 and you invest only $127 a month at 11% interest for 40 years, you're going to end up with almost over $1,000,000. Versus if you start at 50 for 15 years at 11%, you have to invest more than $2,000 a month to have almost the same amount. So you need to start now investing that $127 a month. The first thing you want to do is to conduct a financial analysis. Remember, to get your net worth, it's your assets minus your liabilities, and that equals your net worth. Ideally, your net worth should increase each year. Housing is, if you own a house, it's probably your biggest asset. If large equity, a reverse mortgage could provide additional retirement income. If you sell your home, you buy a less expensive one, and then you can invest the difference to be earning more money. As we talked about in a previous chapter, life insurance is a great way to have some a buffer. But remember, you're going to, as you near retirement, you want to reduce your coverage because your children are self-sufficient, and so then that way you can increase your income by lowering your premiums. Some other investments: after retirement, consider changing your objective from growth to income. Another thing you need to look at is your estimating your retirement living expenses. Once you get closer to retirement, your spending patterns and where and how you live will probably change. Some of the expenses may go down or even go up. For 401 retirement fund contributions, work expenses will go down because you're not spending for gases, lunches, clothing probably will go down. Housing, most of the time, by the time we get to retirement, our goal is to have our house paid off. Also, when you reach 62, 65, your income taxes are probably going to be lower. But other expenses may go up. Your life and health insurance probably will go up unless your employer continues coverage. The older you get, the more medical expenses you're going to have. You're also going to be able to do more, travel more, so you're going to have expenses for leisure activities. And then giving gifts and contribution probably will go up. Keep in mind that inflation will increase amount needed to cover expenses over the course of your retirement. This is just an example of how an average person 65 plus spends its money. Notice that still most of it, 35% is going to be for your housing. Transportation is 14, food is 13, and medical is about 12. And then the rest is just miscellaneous smaller expenses. So one thing you want to do is to determine your retirement income and then develop a budget based on that income. Here are four major sources of retirement income: employer pension plans, public pension plans, personal pension plans, and annuities. Most employer plans are defined benefit or defined contribution. A defined contribution plan has an individual account for each employee, and then these plans are also called individual plans. They can include money purchase pension plans, stock bonus plans, profit sharing plans, and 401 plans. Now, most of them are 401k plans, and it's a salary reduction plan where the employer makes non-taxable contribution and reduces your salary by the same amount. Your employee contribution are tax deferred. Some employers match your contribution, and if you are looking at a company, you always want to look at if they match for 401ks. And then those funds are invested in stock, bonds, and mutual funds. And there's also a vesting period. Generally, the vesting period is 7 years. In a defined benefit plan, the document plan specifies the benefits promised to you at the normal retirement age. What that means is that the employer will pay you a certain amount per month when you retire based on your pre-retirement salary, your number of years. Your employer makes the investment decisions for your contribution and theirs, and your benefit amount stays the same regardless of how the investments perform. The next slide is just a short video that explains the difference between defined contribution and defined benefit.
Hey guys, it's MJ, the student actuary, and today I'm going to be talking about defined benefit versus defined contribution pension funds. And just before we get started, I have to give this disclaimer because I'm not a financial advisor. So don't take this advice and be silly with your money, then come blame me. Anyway, so we can begin. Pensions. What are pensions? Whenever you think of the word pension, you typically think of old people. Why? Because old people are the beneficiaries of pensions. However, pensions actually apply to everyone because it's young people that, well, as soon as you start working, you start putting money aside for your pension. And so you're the contributor and the old people are the beneficiaries, but we just call them pensioners when they start receiving it. So that's why we think they're old people. But it's actually a lifelong product. And my definition of a pension, it is remuneration that aids with your retirement. So it's part of your salary. So when you go work for a company, part of the deal is, yes, I'm going to be paid a monthly amount, which is going to cover all my costs, but I'm also going to be getting this pension fund as one of part of my package, part of my benefits, part of my remuneration, is that some of my money from my salary is going to go into this pension fund, and the company is also going to make a contribution. And the idea is that we put all this money together into a fund, investors take care of it, and then when I retire, I have enough money to continue living without working when I reach a certain age. Now, you get two types of pensions, well, two main types. There's defined benefit, and that is when, with the defined benefit, it says just roughly, defined benefit is when you retire, you will receive 10,000 every month. So they're defining the benefit. You will receive this 10,000 regardless if the stock market crashed the night before you were supposed to get your pensions, or it shot up tenfold. You're going to get 10,000. Whereas defined contribution is the other one, and that one says it doesn't matter. They don't care about your benefit. What they care about here is the contribution is defined. So you will be paying 500 every month towards your pension, whether the stock market's doing great, whether the stock market's doing badly, whether the pension fund's up, whether the pension fund's down, you will be making your contribution of 500, if that is what it's defined to be. So bear that in mind when we talk about, there's two main parties involved in a pension fund. There's lots, but the two main ones are the employer and the employee. Okay? And defined benefit and defined contribution works in favor of the different ones. So, and in order to talk about which one's better, we have to understand risk. So what risk is? It is the probability that you don't get what you were expecting. So the risk in retirement is not having enough money to carry on living. So what's very nice about the defined benefit is that there is no risk for the employee, because the benefit is defined to be 10,000 a month, which means if the pension fund does really badly, the employer has to meet that shortfall and has to pay extra money, and they cover the cost. They take on what we call the risk. So that's good. Well, my opinion, this is not financial advice. So in my opinion, it is much better if you're working as an employee to receive a defined benefit, because this means that no matter what happens in the stock market or whatever is being invested, you will receive your benefit, which will help you live your life. Defined contribution, on the other hand, in my opinion, is very good for the employer, but is not very good for the employee. Defined contribution, the risk is on you, the employee. So you're giving your 500 every single month. If the stock market crashes the night before you're supposed to get your pension, that's tough cookie for you, and life sucks. And that's not really fun. Now, employers try and sell the defined contribution fund to their employees by saying, well, if the stock market does really great, you're going to get even more. But remember, a pension is there, it's more of a protection product to help you live rather than a get-rich scheme. If you want to try and get rich using investments, risk all your money in the casino or in a hedge fund. It's kind of like the same thing. With a pension, you want your money to be safe, and that's what a defined benefit does. However, defined benefits require actuaries to value them and to sign off on them and to give advice. Whereas defined contribution doesn't really need that. It's much simpler to handle. And so I guess in conclusion, because I don't want to make this too much of a long video, I mean, people have written books on the subject, is that if you are an employee, defined benefit is, in my opinion, good, and defined contribution is bad. And my opinion is based on the fact on who handles the risk. Defined benefit, the company's handling the risk. Defined contribution, you're handling the risk. And as an old person who is going to be very dependent on that cash, when they retire, you do not want to be taking that risk. And yeah, that is defined benefit versus defined contribution. If you have any other topic that you would like me to speak on, put it down in the comment section below. Cheers, guys.
Now, some changes that have been made to the employer pension plans. First of all, there's a portability of plans, and it allows you to carry earned benefits from one employee pension plan to another if you change job. And then the Employee Retirement Income Security Act that was passed in 1974 sets minimum standards for pension plans, and the federal government ensures part of the payment promised by a defined payment plan. A public pension plan, of course, is Social Security, and it's the most widely used source of a retirement income. It covers 97% of workers, but it is only meant to be a part of your retirement income, not the sole. Most people cannot just live on Social Security. As you get older and closer to retirement, you'll want to set up an account through the Social Security Administration and kind of keep an accurate account of your Social Security benefits. Full retirement benefits go from 65 to 67, depending on the year of birth. You can start drawing at 62, but it's reduced, and you don't get full retirement until 67. Your benefits are based on your earnings over the years, so the longer you work, the more benefits you're going to get. And then some dependents can receive benefits with your Social Security number. Some personal retirement accounts that we want to talk about to begin with is IRAs, an individual retirement account. We're going to start talking about a regular IRA, which allows $5,500 contribution in 2014 and beyond. If you're over 50, which none of you are, you could do $6,500. Contributions may be tax deductible depending on your tax filing status and income, and you would need to talk with your tax accountant on that. The interest accumulates tax-free until you begin to withdraw. You can begin withdrawing at age 59 and a half, but you have to begin drawing at 70 and a half. Now, most people think IRAs, again, are tax-free, but when you withdraw, it is considered taxable income. A Roth IRA, contributions are not tax deductible, but distribution tax-free after age 59 and a half. Has some of the same contribution limits as a traditional IRA. And then after 5 years, withdrawals are tax-free and penalty-free if you're 59 and a half, or if your funds are used down payment on a first-time home purchase. Now, I'm going to show you a quick video I found that's giving you the difference between a traditional and a Roth. And this manager highly suggests using the Roth, because when you do start getting money, you're going to get higher because of you're in a lower income bracket. The simplified employee pension, known as SEP, SEP, is the simplest type of retirement plan if you are fully or partially employed. It's nothing more than an individual retirement account that is funded by your employer. Employers can make annual contributions up to $50,000, and any employee contribution is fully tax deductible. And again, this is the simplest retirement plan for self-employed people. A spousal IRA. With this IRA, you can make contributions on behalf of your non-working spouse if you're filing a joint income tax. And the contribution limits are the same as for Roth or traditional IRAs. A rollover IRA is a traditional IRA that allows you to roll over or transfer all or just a portion of your taxable distributions from a retirement plan or an IRA. An education IRA, also known as the Coverdell Education Savings Account, is where you can give up to $2,000 per year to each child under the age of 18. Contributions are contributions not taxed, they're deductible, and they're tax-free distribution for educational expenses. COG plans is HR 10 plan or self-employment retirement plan is designed for you as self-employed. You have annual tax deductible contributions limited, but it is difficult to administer. And then there's limits on personal plans. You cannot leave money in a tax deferred retirement plan forever except Roth or IRAs. And at retirement or by age 70 and a half, you have to begin receiving a minimum lifetime distribution. This slide just explains a little bit of each one of the IRA features of the ones that we've just kind of looked at quickly. Annuities is a way of guaranteeing income for life, and you can purchase an annuity with proceeds of an IRA or a company pension. You can use it as a supplemental retirement income. You can have a single or a periodic payment. From an annuity, your interest accumulates tax-free until payments begins. Then those distributions are taxed as ordinary income. There are two types of annuities. You can have an immediate annuity, which means payments begin right away, or you can have deferred annuity, which means payment begin at a future date. The next things we're going to be talking about are estate planning. And when we talk about an estate, it's everything you own. Both of my parents recently died this past year unexpectedly, and it was very difficult going through everything they own and trying to make sure that we had everything in order. So what you want to do is you want to help your family not to have to do all that on their own. So you want to have an estate plan, and an estate plan is a detailed plan for how you want your estate administered, how you want your property, the disposition of your property during your lifetime and at your death. While you work, you accumulate funds for your future and your dependents, but as you grow older, the emphasis is going to shift from accumulating assets to distributing them wisely. So there's some phases you want to think about when you're planning your estate. You're building your estate through savings, investments, and insurance. Ensure that your estate is distributed as you wish after your death. If you're married, you need to consider the needs of your spouse and your children. If you're single, have your financial affairs in order so that there is a beneficiary and that money doesn't go to the state. Make sure important documents are accessible, understandable, and legally proper. Even as a young person, you want to have a will. And a will is a legal declaration of your person's mind as to the disposition of your property after your death. The easiest thing that you can do is have attorney draft it to avoid difficulties, and it can run between $300 and $400. You can get a will online and do it yourself, but if you can afford to, go ahead and have a will drawn up legally. There are four types of wills that we're going to talk about. The first one is a simple or an I love you will, which leaves everything to your spouse, and they're sufficient for small estates. The second one is a traditional marital share will, which leaves half to the spouse and half to the children or heirs. One thing that if your children are under 25, generally you want to put it in a trust. And a trust is an arrangement by which a designated person manages that for them until they become at the age where you feel like that they could take care of the money and not just go out and blow it. Under the exemption trust will, everything passes to your spouse with the exception of an equal amount to the exemption, and a trust can provide a lifelong income. A stated amount will allows you to pass along to your spouse any amount that satisfies the family's financial needs. Intestate is when you die without a will and the state will distribute your asset. That may mean the state will decide who is the guardian of your children, and it becomes very complicated if you're in a blended family. A probate court generally validates wills and makes sure your debts are paid. They're expensive, lengthy, and public. As I told you, my parents passed away. One died in December and one died in February. I am still going through probate court with them. Again, it is expensive, it's lengthy, and it's public. A holographic will is a will that you write, date, and sign entirely in your handwriting. Do know that it may not be recognized in some states. Then there's a formal will, and it's usually prepared with attorney's assistance. You have to sign it and have two witnesses, and they cannot be your beneficiary. And again, a beneficiary is a person you name to receive property. Of course, it does cost to have a formal will. A statutory will is it's the type of a formal will that you can get at a lawyer or stationery store. There is even some online now. It's just a pre-printed form, and but you have to be very careful when you're filling this out because it may include provisions which are not in the best interest of your heirs. Another thing that you are going to want to do is to select an executor of your estate. And an executor is one who's willing and able to execute the provisions of your will. And these are some of the tasks that they may be have to do. And they will have to prepare an inventory of your assets, and it has to be filed with the clerk of the court in your county. You have to do one that's what their assets were at the time of death. Then you have to do another one at 6 months, and then as soon as everything has settled, then you have to do another one to be released as being an executor. They also may need to collect money. They have to do all the income and estate tax returns. They have to make decisions about investing or selling, and then distributing the estate and making financial accounting to your beneficiaries. Also, when you're writing your will, if you have small children, you need to select a guardian. A guardian assumes responsibility for providing for the children with the personal care and managing the estate for them. I thought this was a cute additive here is don't forget any pets in the home. What will you do with your dogs or your cats? They need a guardian too. After you have written your will, you will need to review it and maybe even altering it. I would suggest every 5 years you need to look at your will. Here's some of the reasons you may need to, if you've moved to a new state, there may be different laws. You've sold property that's mentioned in the will. The size and composition of your state has changed. If you've married, divorced, or remarried, or there's new heirs born or died. You can also add a codicil to a will, and that's just a document that explains, add, or delegates provisions in your existing will. Another thing you would want to do is you'll need to have a living will. And a living will allows you to specify whether not to be kept alive on artificial support. You will have a DNR, which is a do not resuscitate. You can also appoint someone to make healthcare decisions on your behalf in case you are unable to do so. Anytime you go into the hospital for surgery, they will ask you if you have a living will. It's best if you have one just to take it with you. If not, they will give you a standard form that you can fill out at a hospital. Another thing you want to do is you want to have two types of power of attorney. You want to have a power of attorney, which is a legal document authorizing someone to legally act on your behalf if you become seriously ill or injured. If you pass away, then the power of attorney is no longer enforced. You also want to have a health care power of attorney, which combines the living will and the power of attorney to make health-related decisions. You can also have a letter of last instruction, and this would be something you would put with your will so that your heirs would be able to have some information that would include what you prefer for a funeral, names of people to be notified at your death, where the bank accounts and safety deposit boxes are, social security numbers, and what are to be done with personal effects. These are not legally binding, but they are very beneficial in when you do die, that all this is already taken care of and helps ease the pain during a death. A trust is a legal arrangement through which your assets are held by a trustee for your benefit or that of your beneficiaries. We talked about that as far as money that you leave to your children. If they're under 25, usually you want to leave money in a trust for them. Some benefits of a trust is that it can reduce estate taxes. It avoids probate and transfers assets immediately. It frees you from managing assets. It provides income for your surviving spouse. And then it also ensures property serves the desired purpose after your death. Some types of trust that you would want to look at is a revocable trust, means that you have the right to end the trust or change anything in it during your lifetime, and it may avoid lengthy probate processes, but it does not provide shelter from federal or state estate taxes. An irrevocable trust means that you cannot change the terms once it's instituted, and it's used to reduce estate taxes, and it avoids probate. A credit shelter trust is also known as a bypass trust, a residuary trust, an AB trust, exemption trust, or family trust. And what that does, it enables the surviving spouse to avoid federal taxes on a certain amount of the assets left to them in the estate. A disclaimer trust is appropriate for couples who do not have enough assets yet to need a credit shelter trust, but may need one in the future. The surviving spouse receives everything, but may disclaim or deny some of the assets. Anything that's disclaimed goes into a credit shelter trust, and what this does is it protects wealth from estate taxes. The last two types of trust is a living trust, and it is in effect while you're alive, and it helps you property management arrangement. Some of the advantages is it ensures privacy. It allows review of your trustee performance. It relieves you of management responsibility. It's less likely to create arguments among heirs, and then it also can guide family and doctors if you're unable to make decisions. A testamentary trust is just established by your will, and it becomes effective upon your death. And the last couple of slides are talking about your taxes when you're thinking about estate planning. Estate taxes is a federal tax on the value of property at death, and they tax it on the fair market value. But in 2012, the exemption was raised to 5.12 million. So helps a lot when we're talking about estate taxes. Federal income taxes, estates and certain trusts must file tax returns, and trust and estate taxes must pay quarterly estimated taxes. An inheritance tax is the tax on the property left by a person in their will. It's imposed by states, and it can be 4 to 10%. Now, gift taxes your parents or even you can give any person a gift of less than $14,000 a year, and it's tax-free. Anything over $14,000 is taxed by both the state and federal government. A lot of parents and grandparents are taking some of their monies and they're giving them to their children, and as a gift now, so that when they die they don't have to pay inheritance tax on it. So that concludes our getting ready for retirement. Again, start now. Don't wait until you're 50. Start when you're 24 and you start to work. Start putting that $124 a month up, and you'll be a millionaire by the time you're 50. I hope you've enjoyed the classes. Good luck on the final exam, and let me know if you have any questions.